Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes.
Okay, right, so let's get right into this. Today we are taking a deep dive into an absolute giant. We're looking at a company that has, effectively become the main character of the stock market over the last few years.
Yeah, the absolute center of attention.
Right. We are looking at Nvidia, ticker symbol NVDA. And usually when people talk about this company, the conversation almost immediately goes straight to the technology.
Oh, always. It's the chips, it's generative AI, the future of computing, all of that.
Right, but that is not what we're doing today.
No, absolutely not.
Today we are completely stripping all of that away. We're putting our blinders onto the narrative.
Just blocking out the noise.
Exactly. We are looking strictly at the math. We're looking at the structure of the investment itself, because you can have the most revolutionary company in the entire world, but, if the math of the investment doesn't make sense, it's a trap.
It's a huge trap. We are looking at the price you pay versus what you actually get. Because in this space, in the world of capital allocation, the story doesn't matter nearly as much as the arithmetic.
Right.
If the arithmetic doesn't hold up, the best story in the world can still lose you money. So we are looking for the structural integrity of the price.
Okay, so let's set the scene with our cold open. This is the setup. We really have to look at the sheer size of what we're dealing with here because it's unprecedented.
It really is.
So we're looking at a share price of $195. That's the sticker price on the screen.
Right. And for a lot of people listening, that number, 195, it doesn't seem too crazy. It sounds, affordable.
Yeah, it sounds like a normal stock price.
But the share price is just one tiny slice of the pizza. You have to look at the whole pie.
And when you take that share price and multiply it by the number of shares out there, you get the market cap.
The total value the market has assigned to this business.
Right. This is where the scale becomes just incredibly hard to comprehend.
It is an economy-sized number.
We are talking about a market cap of approximately $4.7 trillion. Trillion with a T.
4.77 trillion. I mean, think about the GDP of major industrial nations.
Right.
That number is larger than the entire economic output of most countries on Earth. When you have a valuation that massive, the laws of physics, or I guess specifically financial gravity,
Yeah.
they start to apply differently.
Mm.
It takes an enormous amount of energy, or in this case, capital, to keep something that heavy moving upward.
That's a great point. It's like trying to launch a rocket versus trying to move a planet.
Exactly.
Now, to understand if that price actually makes sense, we have to look at what the company earned. We can't just look at the price tag. We have to look at the merchandise we're actually buying.
Right. What are you getting for your 4.77 trillion?
So we are looking at the last fiscal year's diluted EPS. That's earnings per share. And that number came in at $4.90.
Let's just pause and frame that for a second. You have a price of $195. And for that price, you are buying a claim on $4.90 of earnings from the past year.
Just $4.90.
That is the fundamental exchange you are making when you buy a share.
And this brings us to really the most famous metric in investing, the PE ratio. We have to do the calculation here verbally so everyone tuning in can follow along.
Let's run the math.
We are taking the price and we are dividing it by the earnings per share. So PE is price divided by earnings per share.
Right.
That is 195 divided by 4.90.
And when you run that math, the result is roughly 39.8 times PE.
39.8, nearly 40 times earnings.
And that brings us to the core thesis of this deep dive, the outlier.
The outlier, right.
In this specific case, the outlier is the valuation itself.
What do you mean by that, though? Just that it's high?
I mean that a 39.8 times multiple on a company of this sheer size, remember, $4 trillion, is historically incredibly rare. It's an outlier data point.
Right, because usually they slow down.
Exactly. Usually when companies get this big, their growth naturally slows down and their multiple compresses. They start to trade at 15 times or maybe 20 times. To be trading at essentially 40 times earnings at this scale is a total anomaly.
Okay.
And the concept we really need to understand here is fragility. When a valuation is this extreme, the investment case becomes fragile. It loses its structural integrity.
Fragile in what way? Because, if you look at the company, it looks strong, right? I mean, they're selling every single chip they can possibly make.
Oh, the business might be strong, absolutely. But the investment is fragile. There is a huge difference between the two.
How so?
You can have a phenomenal business, an absolute monopoly even, but if you pay a price that assumes perfection, you have completely removed your margin for error. Even a great business can be a poor investment if the price assumes perfection.
And at 39.8 times earnings.
The market is assuming perfection.
Exactly. So basically, the higher the price goes relative to the earnings, the harder it is to actually make a decent return, regardless of how good the product is.
Precisely. You are paying for growth that hasn't even happened yet. You're paying for a future that is completely flawless.
Right.
If the future turns out to be just, good instead of perfect, the stock price has to adjust downwards. That's the risk.
Yeah.
That is where the fragility comes from. If they stumble even a little bit, the fall is much harder because the pedestal is just so high.
Okay, let's unpack this further. We need to look at the full picture here. We have this Outlier scoreboard that we've put together based on their latest financial reports.
Yes, the Outlier scoreboard.
This is where we get into the real nitty-gritty of the metrics. We're going to look under the hood.
This is our dashboard to see exactly how expensive this merchandise is. We need to measure it from every possible angle.
Right. And I'm going to run through these metrics, and I want you, the listener, to listen closely to the definitions because we're going to read the numbers exactly as they stand.
Let's go through them.
First up is the one we just mentioned, the PE. And just to restate, PE is price divided by EPS. We are sitting at roughly 39.8 times.
Think about that in terms of time. If earnings didn't grow at all, it would take almost 40 years of current earnings to make back your initial investment.
40 years.
That is a working lifetime. You are paying up front for 40 years of production.
Okay, next is PS. That is price to sales. And the formula here is market cap divided by revenue. That is coming in at roughly 22.1 times.
Just think about that for a second. You are paying $22 for every $1 of revenue the company generates. Not profit, just revenue.
Just sales at the top line.
Right. If you walked into a retail store and they were selling dollar bills for $22, you'd think it was absolutely crazy. But that is what the market is paying for the sales stream here. That is a very rich multiple.
Next on the scoreboard, PB, price to book. This formula is price divided by book value per share. We are at roughly 30.4 times.
Book value is essentially the net worth of the company's assets on paper. So buildings, computers, cash, minus their liabilities.
Right.
Paying 30 times that means the market believes the intangible value, the brand, the IP, the moat, is worth 30 times the actual physical and financial assets. It implies a massive premium on the magic of the company rather than the actual stuff of the company.
Okay, now let's look at cash. FCF yield, free cash flow yield. The formula here is free cash flow divided by market cap.
So this is basically, if you bought the whole company today, what percentage of your money would you get back in cash flow right now?
Exactly. And the number is roughly 2.02%.
2%. In a world where you can get risk-free rates often higher than that, like in treasury bills, you are accepting a 2% yield because you expect massive growth.
You're betting entirely on the future.
You are accepting a very low current yield for the promise of a higher future yield. But right now, today, the cash-on-cash return is very low.
Let's look at the profitability metrics. Net margin. The formula is net income divided by revenue. It is roughly 55.6%.
That is an incredible number, truly outlier status. 55 cents of every single dollar drops straight to the bottom line.
That's practically unheard of for hardware.
It's a sign of immense pricing power. It basically means they have zero competition right now that can force them to lower prices.
And then there's ROE, return on equity. The formula is net income divided by average equity. It is roughly 101%.
Also an outlier number.
Yeah.
It shows they are incredibly efficient at turning shareholder capital into pure profit. They don't need to build massive factories themselves, which we'll get to later, so their equity base is very efficient.
And finally, liquidity, the current ratio. This formula is current assets divided by current liabilities. We are at roughly 3.91 times.
Which implies they have plenty of short-term assets to cover their short-term bills. On the surface, if you just glance at it, that looks very safe. A ratio of nearly 4 is fortress-like.
Okay, so we have the scoreboard laid out. High valuation, massive margins, huge efficiency. But we need to do a balance sheet reality check.
We do.
Because there are some really big numbers on the liability side, too. We have current liabilities of about $32 billion due within a year.
This is where we really have to pivot. We have to introduce a crucial risk fact into this deep dive. We need to talk about hidden liabilities and supply chain commitments.
Hidden liabilities, that sounds ominous.
Well, they aren't hidden if you actually read the footnotes, but they are absolutely hidden from the headline numbers that everyone retweets.
Yeah.
There is this huge misconception out there that because Nvidia has massive income, they just have billions and billions of spare cash sitting around to give away to shareholders or just do whatever they want with.
Like they're just swimming in a vault of gold coins.
Exactly. Like Scrooge McDuck.
And that's not true.
Not entirely, no. Their capital is highly restricted. Despite massive income, NVDA does not have billions in spare cash to give away. And this is due to two main factors.
Okay, walk us through them. Factor one.
Factor one is what you just mentioned a moment ago, the upcoming bills. They have $32 billion in current liabilities that are due in the next 12 months.
Right.
That is cash that it's effectively already spoken for. It's accounts payable, it's taxes, it's wages, it's money that has to go out the door soon.
And factor two.
Factor two is the really big one. Manufacturing deposits. If you dig into the footnotes of their financial statements, it reveals $95.2 billion in total supply-related commitments.
Oh, $95.2 billion.
Yes. That is a massive number. That is nearly $100 billion.
So let's just dwell on the implication of this for a minute. We see a company making money hand over fist, but this heavily restricts their free capital.
It absolutely does. The $32 billion is visible right there on the balance sheet under current liabilities. But that $95.2 billion figure, that shows how much cash is tied up to secure supply chain capacity.
Because they don't actually make their own chips, right? They just design them.
Correct. They are what's called fabless. They rely entirely on third-party manufacturers, primarily out in Taiwan. And because everyone in the world wants these chips right now, Nvidia has to secure that capacity years in advance.
Right, they have to get in line.
They have to put money down. They have to sign binding contracts. That $95.2 billion is a firm commitment. It effectively locks up their future capital. It is not free money. It is money completely dedicated to survival and delivery.
That puts the cash position in a totally different light. It's not just a vault of cash. It's working capital that is frantically being deployed just to keep the machine running.
Exactly. It is busy cash. It has a specific job to do. It cannot be used for stock buybacks or dividends if it is needed to guarantee the chips actually get made.
Okay, so we have a valuation and we have the commitments. Now we really need to look at the math of the price itself. What must stay true for this valuation to actually work?
This is the core of the analysis. We are sitting at $195 a share. For that exact price to make sense, the company doesn't just need to stay strong. It needs to stay outlier strong.
Outlier strong. I like that. So let's translate that into simple math. We call this the must-stay-true math. We are going to do a stress test right now.
Let's do it.
Okay, the PE stress test. Let's imagine a scenario where the market mood changes. The company is still doing very well, but the market decides that Nvidia deserves a more normal multiple. Let's say a 20 times PE.
Which, by the way, is still a very healthy multiple for a mature technology company. Companies like Microsoft, Apple, and Google have all traded around 20 times or even less in their history.
Right, so if the market re-rates NVDA to a normal 20 times PE, but the share price stays at $195, what does the company actually need to do?
Well, we just do the algebra. To justify a $195 stock price at a 20 times PE, the earnings per share would need to be roughly $9.75. The formula there is 195 divided by 20.
$9.75. And remember, the last fiscal year's actual EPS was $4.90.
So just to keep the price flat, not to go up, just to keep it exactly where it is today, if the multiple compresses to normal levels, they need to essentially double their earnings.
Wow.
This required EPS is roughly 2 times the last fiscal year's actual EPS of $4.90.
That is a very heavy lift. That means perfection isn't just expected, it's mathematically required just to stand still in that scenario.
Correct. It means you are running at an absolute full sprint just to stay in the exact same place.
Now let's look at it from a cash flow perspective, the cash flow stress test.
Right. We said earlier that the fiscal year free cash flow was about $96.6 billion. At the current market cap, that is a yield of about 2%.
And 2% isn't very exciting for a lot of investors, especially when you can get more from a basic bond. So here is the scenario. What if investors demand a 5% free cash flow yield? which is a pretty standard expectation for a mature cash cow business.
If the market demands a 5% yield on a $4.77 trillion valuation, the math gets very intense. The business needs approximately $238.7 billion in annual free cash flow.
The formula there is 0.05 times 4.7 trillion.
Right, $238.7 billion.
And how does that compare to what they are doing right now?
Well, this is roughly 2.5 times the last fiscal year's free cash flow.
So again, to justify the current valuation to a slightly more demanding investor base, they need to more than double their cash output.
That is the ultimate conclusion here. The current price assumes one of three things. Either one, much higher earnings and cash flow are coming very, very soon. Two, investors will remain comfortable with very low yields indefinitely. Or three, a combination of both.
And if any of those assumptions break, the price breaks.
That is the fragility we spoke about in the beginning.
Now, there is a historical framework for this. A framework specifically designed to identify this exact kind of risk. The Benjamin Graham framework.
Yes, Benjamin Graham, the father of value investing, the mentor to Warren Buffett. His framework is completely brutal.
It's not forgiving at all.
It is not designed to find the next hot stock. It is designed to be brutal, to prevent permanent downside. It's a safety filter. He didn't care about the story. He cared about protecting his principle.
So let's run Nvidia through the Graham test. We have the results right here. Let's see how it holds up to the old school.
Let's see.
First, the PE rule. Graham says the PE should be less than or equal to 15.
And NVDA is at roughly 39.8 times.
Fail.
Big fail.
Yeah.
Graham wanted to pay $15 for $1 of earnings. Here you have to pay almost 40.
Next, the PB rule. Graham says price to book should be less than or equal to 1.5.
And NVDA is at roughly 30.4 times.
Another massive fail.
Truly massive. Graham wanted to buy assets close to their accounting cost. Here, you are paying a 30 times premium on the actual assets.
And there is a combined test. Graham allows for a little flexibility if one metric is lower than the other. The rule is that PE multiplied by PB should be less than or equal to 22.5.
If you multiply 39.8 by 30.4, you are in the thousands. You are over 1,200. NVDA is nowhere close to passing.
So what is the verdict from the grave of Ben Graham?
The verdict is that before we even discuss AI, before we discuss leadership, before we discuss the data centers, the price flat out fails the margin of safety gate.
It is simply too expensive by traditional safety standards.
It is priced for a highly optimistic future, not grounded in a safe present. Graham would say this is speculation, not investment.
Now, I want to go a little deeper into the money. We talked about the hidden liabilities, but let's really put on our forensic lens. We need to talk about cash conversion and this idea of busy cash.
Busy cash. I really like that term. It implies the cash has a job to do. It's not just sitting on a beach somewhere.
Exactly. I want to challenge the statement people always make when they talk about this stock. They say, oh, they have a lot of cash. They are perfectly fine. Let's break down the assets.
Okay. If you look at the asset side of the balance sheet, you see roughly $62.6 billion in cash, cash equivalents, and marketable securities. That is the headline number everyone quotes. Look, $62 billion in the bank.
But there are other assets too, right?
Right. There is roughly $38.5 billion in accounts receivable. That is money customers owe them but haven't actually paid yet. And there is roughly $21.4 billion in inventory.
Okay, so $62 billion in cash-like stuff. That sounds like a lot of money. But here's the forensic question. How much is truly free?
To answer that, we have to circle back to the obligations we found earlier.
Let's recap those numbers for you.
Upcoming bills. Roughly $32 billion in current liabilities. That bill is coming due within a year.
And the big one.
Supply commitments. $95.2 billion detailed in the footnotes.
So compare $62 billion in cash assets to $95 billion in supply commitments, plus $32 billion in current liabilities.
The math doesn't look like an infinite piggy bank anymore. In fact, if you net it out, the commitments heavily exceed the current liquid cash.
It looks like a company that is heavily leveraged to its supply chain.
That is the lockup. We have to really explain this dependence on third-party manufacturing. Because they cannot make the chips themselves, they are completely beholden to their suppliers. Cash is spoken for via prepayments, deposits, and long-dated purchase commitments.
Right, so if they don't pay that money, they don't get the chips. If they don't get the chips, they don't get the revenue.
Exactly. The cash is the fuel for the engine. You can't take the fuel out of the tank and give it to the shareholders, or the car just stops.
Let's look at the working capital aspect. You mentioned accounts receivable and inventory.
Yes, both accounts receivable and inventory jumped year over year.
Is that bad?
Context is key here. It is normal for hypergrowth. When you are selling more, you naturally have more inventory moving and more people owing you money. But it is a risk.
Why is it a risk?
Because if growth cools, that cash gets stuck. If you have billions in inventory and suddenly demand drops, that inventory becomes a liability, not an asset. In tech, inventory is like rotting fruit. It loses value incredibly fast. If customers stop paying as quickly, that accounts receivable number balloons, and you suddenly have a cash crunch. Cash gets stuck in the operating cycle.
So we need to watch those lines like a hawk.
Absolutely.
One more forensic point you noticed regarding the quality of earnings?
Yes. Looking at the cash flow reconciliation note, net income includes gains from equity securities.
Explain that for us.
Nvidia invests in other companies. When those other companies go up in value, Nvidia records a gain on their income statement. But that is not cash from selling chips. It is paper gains from investments.
So it basically inflates the net income number.
It boosted it, yes. But when you calculate operating cash flow, those gains are backed out. You have to subtract them because they aren't cash from core operations.
What's the takeaway there for the listener?
The takeaway is that not all net income is of the exact same quality. Operating income from selling chips is high quality. Investment income from stock prices going up is lower quality. We want to make sure we know the difference.
Okay, this brings us to a really interesting thought experiment. We've looked at the current state. Now let's look at what happens if the market changes its mind. We call this, is it priced in, specifically regarding multiple compression.
Multiple compression is the silent killer of returns. It's when the earnings don't drop, but the price investors are willing to pay for those exact same earnings drops.
So let's do the calculation. We are currently at a PE of roughly 39.8.
Right.
The assumption. PE drops from roughly 39.8 times to 20 times. And let's assume earnings stay completely flat. They don't grow. They don't shrink.
Okay. So the business performs steadily, but the mood shifts.
What is the result of that shift?
The price re-rates to roughly $98.
$98 from $195. That is essentially a 50% haircut.
The formula there is 195 multiplied by 20 divided by 39.8.
That is brutal. You lose half your money, and the company didn't even have a bad year. They just had a flat year.
And that is the crucial lesson. This is not a prediction. We aren't saying NVDA is going to $98 tomorrow. This is a stress test.
But it shows the danger lurking under the surface.
It shows that at high multiples, downside can stem purely from valuation math, not just business failure. The business can be perfectly fine, earnings flat, and you could still lose half your money if the multiple compresses.
That is a terrifying thought for people who just look at the stock chart and see it going up and to the right.
It is the gravity of finance we talked about. It's always there, waiting.
So for you, the listener who is holding this or watching this or thinking about this, we need a watch list, a practical watch list to navigate this.
Yes. We need leading indicators, things tied directly to financial statement lines that will tell us if the story is changing before the stock price collapses.
I'm going to list these out, and I want you to tell us why they matter.
Let's go through them.
First, gross margin trend.
Small changes matter at extreme margins. They're at 55% net margin. If gross margin ticks down even 1% or 2%, it signals pricing power is eroding or costs are rising. At this valuation, any crack in the margin story is highly dangerous.
Next, OPEX versus revenue. Operating expenses.
Watch for operating leverage reversal. Right now, revenue is growing faster than expenses, which is great. If expenses start growing faster than revenue, profit margins get squeezed immediately.
Third, accounts receivable versus revenue.
This is an early sign of slower collections. If revenue grows 10%, but accounts receivable grows 20%, it means customers are taking longer to pay. That is a huge red flag for demand quality.
Fourth, inventory growth.
Watch for channel digestion or product transition risk. If inventory piles up, it means they made chip they haven't sold yet. In the tech world, old inventory becomes obsolete inventory very fast.
Fifth, current liabilities.
Monitor if the approximately $32 billion upcoming bills figure rises. If that number balloons, the liquidity crunch gets tighter.
Sixth, FCF versus net income. Free cash flow versus net income.
This monitors cash conversion quality. As we said, net income can have non-cash stuff in it. FCF is the absolute truth. If net income goes up, but FCF goes down, watch out.
7th, share repurchases versus FCF.
The sustainability of buybacks. Are they buying back stock with free cash flow, or are they borrowing money or using cash they need for operations? Buybacks are great, but not if they weaken the core balance sheet.
8th, data center concentration.
This is the dominant revenue driver right now. If you look at the disclosures, almost all the growth comes from data center. If that one segment sneezes, the whole company catches a cold. It is a massive single point of failure risk.
9th, third-party reliance.
Watch for language regarding constraints or prepayments. If suppliers raise prices or limit capacity, Nvidia is squeezed. Watch the wording in the filings very closely.
And finally, the big one we keep harping on, supply chain commitments.
Track the $95.2 billion figure in the footnotes. We absolutely need to see how much capital remains locked up. If that number keeps growing, their financial flexibility keeps shrinking.
That is a very comprehensive list. If you are watching NVDA, you should have these metrics front and center.
Absolutely. Don't just watch the stock price, watch the business.
Okay, let's wrap this up. We have covered a lot of ground today. We've looked at the valuation, the Graham test, the forensic accounting, and the stress tests.
So let's land this plane. Nvidia's results are outstanding. There is no denying that fact. The growth is real, the margins are real, but the valuation is doing the heavy lifting.
That is the key distinction to make. Great company, expensive stock. And the risk-first takeaway is simple. When the price assumes outlier margins, outlier growth, and outlier cash generation, you desperately need a margin of safety.
And right now, the Graham-style margin of safety just isn't there. The math simply doesn't support it.
Especially when you factor in the required busy cash reality.
We cannot forget that. Factor in the approximately $32 billion of near-term liabilities.
And factor in the massive $95.2 billion in supply chain commitments locking up their capital.
The money is there, but it is working. It is not free to save you if things go wrong.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.